And we've talked ad nauseum about the kind of wealth that people have created if you invested into an HDFC early, if you invested some of the others early. The idea of doing this discussion today is try and figure out what some of the players with relatively smaller books, how are they seeing the market going ahead, and what is their thought process about how they will be 10 years down the line. And to talk about that, two gentlemen, separate books, of course. One of them is Mr. R. Vardarajan, MD of Repco Home Finance. The other one is Anil Sachidanand. He's MD and CEO of Aspire Home Finance, which is a subset of Motilal Oswal, the listed entity. Gentlemen, both of you, thank you so much for joining in. Mr. Vardarajan, let me start off with you. We've talked a number of times about the kind of lending that you're doing, about the spreads that you enjoy. Right now, I want to talk about the kind of growth rate that you see on your book from a perspective of the next 5 years. What's the kind of CAGR on your book that you envisage for the next 5 years?
See, if you see in the past, we were able to have a CAGR of around 28 to 30%. Even last year, if you see our book growth, it grew at 28%. We very strongly believe in the next 3 to 5 years also we will be able to clock the growth rate of between 25 to 30%. That's what we are envisaging.
What is so great about this 25% number? Irrespective of how good the economy is, how bad the economy is, you grow at 25%. So bad year you should grow less, good year you should grow more. Why are numbers so consistent?
This is for housing. So what we are focusing is mainly in tier 2 and tier 3 cities for home buyers for their individual needs. It's not for any investment. So if you see the investment, then you can say, no, it depends on the economy. But when you are focusing on the tier 2, tier 3 cities, particularly on the affordable section, definitely the trend will be the same. Everybody would like to have a house of their own. It is the dream. And when we fulfill their dreams, we very strongly believe we will be able to have the same growth of 25%. It should not be difficult. Even if you see the market size, about 63% is by the banks and some 37% is from the HFCs. But if you see the growth rate, HFCs were growing at around 22% and banks were growing at 18% as well as housing loan sector is concerned. And that has also been consistent in the last 2-3 years if you see.
Anil, I want to get you in on the discussion as well. What, according to you, is the reality on ground? Because the stock markets are clearly very, very excited about this entire pocket. Do you also envisage a 25% plus kind of growth number, or do you think it's going to be more moderate than that in the year to come?
I think when we look at Repco, which is established for 15-16 years back, or many other housing finance company which has been established before, a growth rate of 25-30% growth rate, much above the industry growth rate, is well accepted growth numbers for the market and for the balance sheet size that they operate. For companies like us, as Aspire Home Finance, which is just 2 years old, a new beginning in the Indian home finance, for us a growth rate of 50%, 60% CAGR looks to be a possible numbers in a market which is very deep, especially the affordable segment, especially the rural segment of market, which is extremely deep. And when we look at this market segment particularly, there are a few dynamics that is impacting this market segment. One of the dynamics is in India, we have seen a nuclearization happening in the metro or the urban customer. Now you see the nuclearization happening in the small ticket or the low income or the middle income customer segment in the tier 2, tier 3 markets. So the dynamics of nuclearization or the split of joint family into multiple families is adding to the number of housing stock requirement in those segments. Adding to that, I guess the urbanization factor that is happening across the length and breadth of the country is also helping in the spread of housing in the fact of the growth that one sees in this market. Well, there is a lot of history of housing finance company. Housing finance company is now 4 decades plus in the market. They are a specialized entity. And when we go back into the market and look at parameterized lending to a metro customer, which has a Form 16, and then you lend to them, and then there is a non-metro customer or a small ticket, low income housing family customer, you technically have to create expertise in understanding the disposable income of the family, and that's where the challenge lies.
Yeah, but which I'm sure companies like yours have done. So, but the question that comes in, and I'm just asking you to validate your confidence, when you're starting off on a smaller book, it's relatively comfortable to grow at a high growth rate with lower asset quality issues. Now you have had 2 years of history behind you.
True.
Do you foresee a 50% CAGR for the next 4 or 5 years? And will that happen with you maintaining the asset quality, or could there be a slight rise in the asset quality stress as well?
So let me take the asset quality first. In a sense, from the industry records, one is very clear that a specialized home finance companies, and to give a small history of home finance company today, when we as Aspire Home Finance got the license, we were 62nd home finance company to get license, and today we have 75 home finance company. And what I gather from the NHB record, which are regulators of home finance companies, probably another 7 or 8 more housing finance companies are coming in. So when clearly the entire history of 4 decades of housing finance has seen a maximum overdue or a default, an arithmetical default of 2% on the book size. So clearly, housing being the largest investment in the lifetime of the individual, and the amount of own equity that they bring into the table for constructing the house, the default has a class, especially in the asset class of housing, is fairly low, and which is well established now as a market practice. Coming into the growth, to answer your question on the growth side, yes, we are a new home finance company, and hence the growth pattern can be looked at in a very different perspective. But do we see ourselves growing at a 30, 40, 50% CAGR? The answer is yes, we can see ourselves growing at 30, 40% CAGR, because we have started off with Central India, with having branches in Maharashtra, Gujarat and MP, and as we expand down to Tamil Nadu, Karnataka, Chhattisgarh, Gujarat, Chhattisgarh, and Rajasthan, perhaps we could see the same growth rate happening. But I have to say that what Varatharajan says on Repco, clearly as we grow, as we progress, the issue is not on the demand side of the housing. The issue is on the supply side of the housing, and that's where the challenges comes in. Whenever a public housing agencies comes out with the public housing, you see a demand of 1:16 or 1:20 coming for one house requirement. The same is not the case when in a sub-metro market or an extended suburbs of metro market. So there is an interesting phenomena developing, and I guess as a practitioner in the industry, having spent 25 years in the industry, I do see a lot of strength in this market.
Okay, Mr. Varatharajan, now the HFC industry may be a 3.5 decade old industry. But now if I just look at the landscape, the Tatas are in it, Bajaj is present there, banks, they want to be there, Mahindra and Mahindra Financial has a subsidiary. Now I understand the big picture that Indians, they want to buy homes, per capita is increasing, we are still a young country. So I understand the demographics advantage. But my question is that if there were 4 players, now there are 40 players, and when there are 40 players, there will be intense competition. And India is not the most effective country in terms of rate transmission. So what happens to the spreads?
No, see, that's what I'm telling. See, number one, what you have to see is the report of agencies like CRISIL, which has very clearly stated the penetration is very, very low. It's only around 10% and below. Therefore, the cake is very large. In fact, I have been telling very frequently we should have more and more players to come in to cater to the needs of this segment. Because earlier, if you see, the housing finance companies were focusing only on salaried sector, and particularly in the urban centers. But the vast majority of the people are in tier 2 and tier 3 cities, and most of them are non-salaried. So therefore, as we earlier discussed, expertise is required in assessing their income and also underwriting their credit proposals. Therefore, definitely more and more players can come, and they will have same very good business. That's what I feel.
So at Aspire then, right now, Anil, what is the strategy really going forward? I mean, do you plan to diversify from tier 2, tier 3 cities? Are you planning at increasing your loan ticket sizes? How do you go about in terms of expansion from
Interesting. I think we have strategically and philosophically, we want to keep it very simple. We wanted to do 100% retail home finance. So there's a uniqueness in Aspire when it comes to doing only 100% retail home finance. While regulatory arbitrage allows 25% of the net worth to be done for non-housing finance, but we believe that non-housing finance activities, the activities of the banks or other NBFC, specialized NBFC. So as a specialized...
So you will not give money to a builder?
We are not giving money to a builder. So to answer it, yes, we are not. So we may not be the darlings of builders. But we certainly indirectly, we indirectly, and I do want to kind of challenge that notion that developer community today, when we look at the total exposure of developer community, the real estate commercial borrowing, it's less than 4% of the total lending in the. So you can't develop the housing as an overall thing if we have only less than 4% of the lending towards real estate commercial borrowing. But there are certain things that could add up to the housing sector, and that's one of the things that I believe could add up largely to the housing sector is the possibility of bringing some regulatory intervention of hoarding, putting up a hoarding tax or some kind of penalty measures for properties which are getting hoarded back. Because today when we look at housing stock, and a lot of analysts come back and say X number of housing stock is available, unsold, the market is going bad. But does one ask this question to the developer that do they want to really sell the property? If there is, in the same market, if a public agency comes out of a project and there is 1:16 buyer available, the same builder could easily sell the property had he priced it properly, since they are holding it back, and that holding time is something that is adding to the cost of the property, and somewhere I guess that's what is hurting the availability of the common man to get into the housing.
And I think Raghuram Rajan too has made reference to that ad nauseum a number of times in the past as well. So I think that's a fair point. But I think, we're just getting close to the wrapping up of this discussion. Mr. Varadarajan, I just want you to come in with a comment on this whole interest rate cycle as well, because earlier it was believed that for companies such as yours or NBFCs by and large, with India being in an interest rate reduction cycle, it will only augur very, very well for NIMS margins for companies such as yours as well. That doesn't seem to be the case anymore, because everybody's now penciling in a maximum of 25 bips, if not a 50 bips rate cut for the rest of FY17. Is that a bit of a dampener? Would you have hoped for inflation to be non-sticky and therefore more interest rate cuts coming in?
No, I don't believe in that. Even